All right, welcome. Today we're tackling a massive topic for any UK landlord, and that's tax. And we've got the experts from my tax accountant helping us out. Look, profits are being squeezed, the rules are always changing, so we're going to get crystal clear on exactly what you can and what you can't claim for this coming 2025-26 tax year. Let's get into it. So let's just cut right to the chase, shall we? Here's the big question. Are you, as a UK landlord, leaving thousands of pounds on the table for the tax man? Because honestly, it's a very real possibility if you don't know every single little expense that you're allowed to claim. And that's why we're so glad to have this guide, which has been put together by the experts over at my tax accountant. I mean, these guys live and breathe this stuff, so you know we're in very safe hands as we break down exactly what you need to know. Okay, so here's a quick look at what we're covering. We'll kick off with the Landlord's Tax Challenge, then get into the Golden Rule, that's revenue versus capital. After that, we'll dive into claiming your running costs, untangle the Section 24 puzzle, look at other key tax reliefs, and finish up with your next steps. Sounds good? Let's go! Right, first up, the Landlord's Tax Challenge. So why does this matter so much right now, heading into 2025? Well, the truth is, for a lot of landlords, profit margins are, frankly, tighter than ever. You've got rising costs, you've got complex regulations, and it all means that getting a grip on your tax isn't just, good practice anymore. It's absolutely essential for survival. And just look at this number, 25%. What does that mean? Well, for some higher rate taxpayers, some of the recent rule changes have meant their tax bill on their rental profits has shot up by 25%. Or even more. That is a huge hit to your bottom line. And it's all because of one very specific, game-changing bit of legislation that we are definitely going to unpack in a bit. Okay, now for the most important part. Seriously, this is the absolute foundation of landlord tax. If you can get this one concept right, you've unlocked the key to making all your legitimate claims. We're talking about the golden rule, the difference between revenue and capital expenses. And the best way to think about it is like this. HMRC basically gives you two buckets to put all your costs into. Bucket number one is for your everyday running costs, the general wear and tear stuff. Bucket number two is for the big things, the long-term improvements that actually add lasting value to your property. If you can just get your costs into the right bucket, believe me, you are halfway there.
And here we go. This lays it out perfectly. Over on the left, you've got your revenue expenses, your day-to-day stuff. Things like letting agent fees, your insurance, replacing a broken window. You get the idea. Then on the right, you have your capital expenses. These are the big upgrades. We're talking about extending the property, adding a conservatory, or, as you can see, upgrading a kitchen for the very first time. See the difference? One's maintenance, the other is a major improvement.
Let's use an example that HMRC themselves love to use, just to really nail this down. Okay, imagine a storm blows a few tiles off your roof. If you just replace those tiles to get it back to how it was, that's a repair. It's a revenue cost. Simple. But if you decide to replace the entire roof, well, that's an improvement. It's a capital cost. You're not just fixing it anymore, you're fundamentally upgrading the whole asset for the long haul. So that's the question you've got to ask yourself every time. Am I restoring it or am I improving? Okay, Section 3, claiming your running costs. So now that we've got that golden rule locked in our minds, let's get down to the nitty-gritty. What are the common everyday running costs, those revenue expenses, that you absolutely can and definitely should be claiming on your tax return? First up, let's talk about management and professional fees. Now, most landlords know they can claim their letting agent's fees. That's a given. But what about the other stuff? We're talking about legal fees for renewing a lease, eviction costs if you're unlucky, and, of course, your accountant's fees for doing all this paperwork. Even ground rent and service charges count. It's all part of the cost of doing business, so make sure you're claiming it. Next, we've got property maintenance and repairs. This is a big one. It's all about just keeping the property in a good, lettable condition. So think repainting and decorating between tenants, fixing that broken boiler or leaky tap, maybe treating a bit of damp. Oh, and if you pay for a cleaner or a gardener for communal areas, yep, those costs count too. Just always remember that golden rule. This is about repairing, not improving. All right, here's a brilliant pro tip for you because this one catches so many people out. The legal fees you pay for the very first letting of a property, HMRC sees that as a capital cost, so you can't claim it as a running expense. But the legal fees for renewing a lease that's less than 50 years long, now that you can claim. It's a really subtle difference, but it's super important to get it right. And let's not forget all the other little bits and pieces that really add up. So, what about those empty periods between tenants, the void periods? Well, any council tax or utility bills you have to cover then, you can claim for those. Your landlord insurance policies? Absolutely deductible. And think about travel. If you're driving to the property for visits or inspections, you can claim mileage. Even the small stuff, stationery, phone calls, postage, if it's for your property business, it all counts.
Okay, deep breath. Let's tackle the big one, the Section 24 puzzle. Honestly, this is, without a doubt, the most significant and, let's be real, the most confusing tax change to hit landlords in a generation. Getting your head around this is absolutely critical to understanding your tax bill. So, what on earth is it all about? Well, before 2017, things were pretty straightforward. You could deduct 100% of your mortgage interest from your rental income. Simple as that. But now, that's all gone. Instead of a deduction, you now only get a 20% basic rate tax credit on your interest payments. Now, that might sound like just a small change in wording, but trust me, the financial impact is anything but small. Now, this didn't just happen overnight. It was phased in gradually over 4 years, starting back in 2017 to sort of ease landlords into it. As you can see, each year the amount you could deduct got smaller and smaller until we got to where we are now, where 0% is deductible, and it's all handled through that 20% tax credit system. And here's the real kicker. This is the dangerous part. Because you can't deduct that mortgage interest anymore, your taxable income, your on-paper profit, looks way bigger than it actually is. This can artificially inflate your total income, and that is what can shove you into a higher tax bracket, even when the actual cash you're making hasn't changed one bit. Now stay with me here, because the next bit shows you exactly how this works with real numbers. Okay, let's look at a worked example. This is how things were before Section 24. Let's say you've got rental income of £30,000. You take off $3,000 for other expenses, and then, crucially, you deduct the full £15,000 of mortgage interest. That leaves you with a taxable rental profit of just £12,000. Add that to your £45,000 salary, and your total taxable income was $57,000. Easy enough, right? Now, let's look at the exact same landlord after Section 24. The rent is the same, the other expenses are the same, but hang on, look what's happened. The mortgage interest is gone from this calculation. Your taxable rental profit has suddenly jumped from £12,000 all the way up to £27,000. Your total taxable income is now a whopping $72,000, and that pushes a whole chunk of your earnings into the higher rate tax band. Even though you get a £3,000 tax credit at the end, your final bill is way higher. That right there is the Section 24 trap. Phew, okay, I know that was a bit heavy, but it's so important to understand. So moving on from running costs and the Section 24 nightmare, let's look at a few other key tax reliefs you need to have on your radar. So let's talk about something every landlord has to deal with. What happens when you have to buy a new fridge for your tenant, or a new sofa, or a new washing machine? The old one's given up the ghost, you have to replace it. How does HMRC let you account for that cost? Well, it's covered by something called Replacement of Domestic Items Relief. This means you can claim the cost of replacing movable items. So we're talking furniture, appliances, even kitchenware. But the key words here are replacement and like for like. You can't claim for buying all the stuff to furnish a property for the very first time. And if you replace a cheap old fridge with a super fancy new one, you can only claim for the cost of what a modern equivalent replacement would have been. Makes sense, right? Okay, now for a really big change that kicked in from April 2025. This is for anyone who owns a furnished holiday let. For years, FHLs had some pretty sweet tax advantages compared to regular buy-to-lets. Well, that party is officially over. The government has scrapped the entire FHL tax regime. So what does that actually mean for holiday let owners? It means they're now treated exactly the same as any other residential landlord. So their mortgage interest relief? Yep, it's now restricted under those same Section 24 rules. Those capital allowances they could claim on furniture and fittings? Gone. And those really nice capital gains tax reliefs they got when they sold a property? Also gone. This is a massive, massive shift. And if you own a holiday let, you need to completely rerun your numbers. Right, we've covered a ton of ground here, from the absolute basics right through to the latest big changes. So let's boil it all down. What are the key actionable steps you should be taking away from all this? Here is your landlord tax checklist. Number 1, track absolutely all of your expenses. Keep every single receipt and invoice. 2, always separate your spending into revenue and capital. 3, you have to understand how Section 24 is impacting your final tax bill.
4. If you own holiday lets, you need to review your entire portfolio strategy like yesterday. And finally, number 5, and this is probably the most important one, get professional advice. Don't try to do this all on your own.
Now, just a quick but very important disclaimer. All the information we've gone through today is for general guidance only. You know, tax law is incredibly complex and it's always subject to change. And for that exact reason, you really must consult a qualified professional who can look at your specific situation before you make any big financial decisions.
Which really leaves us with one final big question for you to think about. With this tax landscape constantly shifting under our feet, is your strategy actually keeping up, or are you at risk?
If you want to make absolutely sure that you're compliant, and more importantly, that you're not paying a single penny more in tax than you legally have to, then get some expert, tailored advice. The team at My Tax Accountant are the people to talk to, and their details are right there on the screen for you.
And hey, if you want to read up on this in more detail, you can find the full article covering everything we've discussed on their blog. The address is right there for you.
And last but not least, if you found this guide helpful, please don't forget to subscribe to the YouTube channel for more essential guides for UK landlords. Thanks so much for watching.